A competent and successful investor is one who measures and evaluates the performance of their investments over time. And so I feel it's very important to understand how to do just that, which is where return on investment, or ROI for short, comes in. Hey guys, I hope you're doing well. In this video, we're going to be talking about what ROI is, how to interpret it, and how to make sure you're using it accurately and effectively. Just before jumping in, if you like content like this and want to know more about the stock market, consider subscribing to the channel and put the notifications bell on so you never miss an upload. So return on investment, or ROI, is a financial ratio investors can use to evaluate the performance of one of their investments, and they can use it to compare the performance of one investment to another. ROI is best used alongside return on assets and return on equity so that the company's profitability is fully understood, as well as your own investment's profitability. I've made videos on these ratios and I'll leave links to them in the description below. ROI, as the name suggests, shows an investor how much a return an investment has produced for them, so it's definitely a good ratio to get to grips with, and luckily it's very simple. ROI is the relationship between the investment gained and the investment cost. So in other words, it illustrates how profitable, if at all, an investment is, which is why it's such a good comparative ratio. A positive ROI means that the investment has produced a gain higher than its cost, and therefore you've made a profit. But if the ROI is negative, it means that the investment has not produced a gain higher than its cost, and therefore you've made a loss. There are two types of ROI, regular ROI and annualized ROI. I'll talk about regular ROI first and give a couple of examples, then talk about annualized ROI further into the video. You can calculate regular ROI by dividing net profit, which is just another way of saying investment gained, by the investment cost. Since it's expressed as a percentage, you need to multiply it by 100. Now it's important to understand what contributes to net profit and investment cost, because net profit isn't just the difference between the stock price when you invested and the stock price when you sold, just as investment cost isn't just the initial cost of the investment. An investor's net profit can be attributed to by the difference between the purchased share price and the sold share price, otherwise known as capital gains, or any dividends received whilst holding the stock. The investment cost may be attributed to by the underlying investment cost, so how much did the shares initially cost, any capital gains taxes you've had to pay, inflation, transaction costs, which come from the brokerage you're using, and they are just how much you've had to pay to actually process the trade. And what may be most important is opportunity cost. Now this is just what you could have spent the money on if you hadn't have invested it. Now that we've cleared that up, I think it's best to look at a couple of examples. We'll look at a simple one first, and then we'll go into a more complex one after. Let's say we have two companies, company ABC and company XYZ. You invest $1,000 into both companies while they are both selling for $5 per share, meaning you now own 200 shares in both companies. After a year has passed, you decide you want to sell the shares you own in both companies. Company ABC's share price has risen to $12 per share, while company XYZ's share price has risen to $8 per share. By using the aforementioned calculation and dividing the net profit by the investment cost and multiplying by 100, we find that company ABC has an ROI of 140%, while company XYZ has an ROI of 60%. Clearly based off of this, company ABC is by far the better investment, as you've over doubled your money. But now let's have a look at a more complex example. Say we have Jimmy Bob, who's invested $10,000 into Gary's Gears and another $10,000 into Mechanics R Us, two vehicle repair companies. Their shares are both selling at $10 per share, which means that Jimmy Bob has 1,000 shares in both companies, and the transaction cost for making these trades was $20. He holds on to his investment for 1 year. Gary's Gears has a dividend yield of 10%, while Mechanics R Us has a dividend yield of 6%. If you're not too sure what dividend yield is, I've made a video explaining all about it, the link to which will be in the description below. This means that over the year Jimmy Bob held his investment, he earned $1,000 in dividends from Gary's Gears and $600 in dividends from Mechanics R Us. Now over the year, Gary's Gears share price decreased to $9.50 per share, while Mechanics R Us share price increased to $11 per share. This means the $10,000 invested into Gary's Gears has decreased to $9,500, whereas the $10,000 invested into Mechanics R Us has increased to $11,000. Therefore, we can calculate the net profit by multiplying the change in the share price by the number of shares owned and then adding the dividends received, making the net profit for Gary's Gears $500 and the net profit for Mechanics R Us $1,600. If we then divide these numbers by the investment cost, which we find by adding the initial investment of $10,000 and the transaction cost of $20, we will find that Gary's Gear's ROI is 4.99%, whereas the ROI for Mechanics R Us is 15.97%. Therefore, Mechanics R Us is the better investment. What this example also illustrates is that just because an investment has a higher dividend yield doesn't mean it's a better investment. And so it really points to the fact that it's important not to base an investment decision off of one indicator. Rather, use a large variety of indicators before coming to a final investment decision. Now, I'd also like to bring to light that someone's ROI calculation may actually be a misinterpretation of what the return actually is. Looking at the two previous examples, it's clear to see that taking every cost into account significantly changes the ROI number. So make sure that when you calculate your own ROI, you take into account all the aforementioned costs so that your ROI is as accurate as possible. The examples we've looked at so far have all been regular ROI calculations, but as I mentioned previously, there's also annualized ROI. Annualized ROI is the ROI relative to how long the investment was held for, which is something that the regular ROI doesn't account for. You can calculate the annualized ROI by dividing the end value of the investment by the beginning value and raising it to the power of 1, and then dividing by the amount of time the investment was held for and subtracting 1. Let's give an example of the difference between the regular ROI and the annualized ROI. Say you bought a property for $300,000 in 2017 and sold it for $650,000 in 2019. This would make your regular ROI 117%, whereas the annualized ROI would be 47.2%. These are very clearly substantially different, so it's important to keep them both in mind. As always, I really hope you've enjoyed this video and learned something new. If you do like content like this, consider subscribing to the channel, and if you have any topic suggestions for future videos, leave them in the comments below and I'll try my best to get to them. Thanks for watching.